morning, everybody. Happy Wednesday, and welcome back to Beat the Bell. Hope you guys have all been having an awesome trading week. Obviously, the Bulls have been in full control. Back to regularly scheduled programming, much of what we saw in July. We're ready to rock this morning. Matt is back on the show. Matt, good morning to you. How you doing?
Morning, guys. Thanks for having me.
All right, Diamond Trades. Good morning to you.
Alejandro, what's going on? Good morning. Excited to be here. Let's get after it.
Stock Snipa.
Good morning. Let's get to bet the bell, the best part.
And Money Mander.
Good morning. How good does that feel to say the Bulls are in control yet again?
It's phenomenal. It's a great feeling. It's what everybody wants to see. All right, Fed forecast and economic calendar. Let's do it.
Yes, sir. Yes, sir. Let's kick it off with the economic calendar for today and the rest of the week. We have got GDP growth estimates, which actually just came out this morning. I'll get those to you in a little bit. Pending home sales still to come at 10 o'clock tomorrow. Core PCE month over month. High impact news before the open. We've also got a Fed speaker tomorrow, weekly jobless claims, and PMI. Friday's a big day with unemployment numbers and NFP before the open, and then ISM manufacturing index at 10 o'clock after the bell. So today the GDP growth estimate came in at 2.1 versus 2.4% expectation. So a little bit lighter than anticipated. Those are just estimates for Q2, by the way. The actual numbers will come out, I believe, next week. So just an estimate, but the market popped a little bit on that number and is pulling back here. The indices, as Alejandro mentioned, rallied really aggressively to start the week so far. On the back of the cooler than expected JOLTS number and a lower than anticipated consumer confidence number, both potentially showing that the economy may be cooling down, which should put downward pressure on future interest rate expectations. And that GDP number, again, this morning that came in lighter than expectations is another one that sort of bolsters the bull case that if the economy is going to slow down, the Fed should be more or less at the top of their hiking campaign. And actually, the sooner that the economy cools down, the sooner that the Fed can pull rates back into less restrictive territory, which obviously is good for stocks in the economy. And so I think that's what people are really looking forward to here. And I think that's really what the rally was about yesterday. Yesterday, the S&P gained 1.5%, while the Dow gained 0.8%, and the NASDAQ had an absolute ripper, closing up 1.7%, added 293 points, was up 300 points intraday at one point. So a ridiculous day for the NASDAQ. Shares of mega cap tech names that have led the market in the past several years have also showed strength this week. So since Friday's close, we had Tesla and NVIDIA adding 7.4% and 6.3% respectively, while Meta tacked on 4.5%, Google added 4%, and Apple up 3.3%. So you like to see those names participating whenever we have a rally like we saw yesterday. Obviously, those are the names that sort of lead the stock market, and to see those names showing strength, which they really haven't for all of August, is definitely a good sign for the bulls. Bond prices have also been rallying, which pushes yields down. The benchmark 10-year yield is down to 4.121% from its highs of around 4.3%. Elevated yields are seen as a headwind for stocks, particularly tech stocks. So seeing them come down adds a little bit of substance to the rally in mega caps that we've seen over the past few days. So really just all positive news so far this week in terms of the stock market and the bull case. So something that we'll pay attention to into the end of the week here as we get additional data on the economy, and we'll see if that sort of cooling narrative is still in play after we get the NFP number on Friday. The last thing I'll talk about is the grayscale win that we saw yesterday that sent crypto stocks absolutely soaring. So yesterday, a federal appeals court ruled the SEC must reconsider Grayscale's application to launch the first ever Bitcoin ETF. So Grayscale is an investment manager that has an ETF, the GBTC, GETH. And essentially what they're trying to do is they're trying to launch their first Bitcoin ETF, and the SEC actually had blocked them from doing that. This is really big news. This ruling is really big news as it sort of opens the door for the first Bitcoin ETF and subsequent, obviously, Bitcoin ETFs as other players try to get into this space. If you look at the last 12 months, from the FTX collapse to the Coinbase Wells notice that they received a couple of months ago, the crypto industry sorely needed some good news, and that's exactly what we got yesterday with the appeals court paving the way. The denial of Grayscale proposal was arbitrary, and was arbitrary because the commission failed to explain its different treatment from similar products. That's what the circuit judge said in the ruling. The news obviously sent Bitcoin and crypto-related assets soaring. Bitcoin futures rose 6.5%, with Ethereum adding about 5%. Coinbase rallied more than 7%, and Grayscale was up 13%. An interesting thing about Grayscale is that they own a bunch of Bitcoin, and you're basically when you're buying one of their ETFs, you're buying into basically this massive pot that they've got. And it's not essentially an ETF, but it sort of works the same way. And because of this ruling, they were actually trading at a pretty steep discount to their net asset value. So they have, X amount of dollars in Bitcoin. But if you look at the market cap of that ETF, it was actually trading at a discount to the amount of Bitcoin that they own, because people were really unsure what was going to happen with this ruling. But if I meant to send you that chart, Ryan, I didn't. But the discount for Grayscale to essentially the amount of assets that they hold, Grayscale was trading at a 25% discount to their asset value yesterday before the ruling. After the ruling, that discount jumped from 24 to 18%. So getting closer to that net asset value there. I know that's something that a lot of people were talking about ahead of the ruling as a potential play, going into it. So it's good to see that gap closing if you are a GBTC investor. So while this is a small win for the crypto industry, certainly not out of the woods yet. Now that the appeals court has made this ruling, the SEC has several potential options. They can either appeal to the Supreme Court, they can grant Grayscale's application, which is obviously the best case for the Grayscale shareholders, or they can deny it again based on some other justification. So it'll be interesting to see how that plays out going forward. Definitely not out of the woods yet for the crypto industry and Grayscale in general. Mander, what do you got?
I think you hit the nail on the head that we'll see what we get going into the end of the week with NFP. But so far, the story of the week so far has really been the pullback in yields and the dollar kind of stemming this rally we saw yesterday after the JOLTS print. So the JOLTS came in about 1 million jobs under estimates. And obviously that's going to go contrarian to the higher for longer narrative. When you don't have unemployment shifting, but you have JOLTS coming down, it finally shows one thing, and that it's people are going back to work. And so it took this long to see the lag in policy finally start to make a meaningful impact, but people are finally going back to work that had removed themselves from the workforce, because when you're retired, you're not in that unemployed category. But then as we see job openings going down like this, either jobs are closing openings that they had, or people are returning back to work from outside of the workforce. And those are the two things you really want to see to finally, kind of confirm that this inflationary measure we had is cooling. And so I think that's the big thing. After seeing the 10-year and those longer duration, the 30-year trading at like 15-year highs, as we were really starting to price in an aggressive higher for longer narrative, because obviously when sentiment shifts, it always shifts a little too far to either direction. We're finally starting to see those pull back to, kind of stable levels where they've been historically. So I think that's the big thing. Dollar rolled over a good bit yesterday. People are finally starting to think this isn't going to be as bad, and putting a bid back in the stock market, and putting a bid in one name in particular that I wanted to cover, which is our beloved Google that we've been talking about for seemingly forever now, as it kind of lagged behind the whole AI move we saw year to date. Finally getting a close at new year-to-date highs, actually edging Microsoft now significantly in gains on year-to-date. And they announced yesterday they're finally going to be selling broad access to the powerful AI tech for the first time, as they're trying to, make up that race in this lucrative cloud software market. So for $30 a month, perfectly matching Microsoft's 365 suite, corporate Gmail customers can get access to a number of tools that will help draft emails and summarize lengthy documents, pretty much everything that OpenAI and ChatGPT can do for the Microsoft Azure and that whole cloud service. And they perfectly matched it, kind of stabbing Microsoft right at it, didn't even undercut them or go over. So they're kind of showcasing what it could do on top of everything that people are going to be using for kind of business fundamentals. They were showcasing that you can use the technology. They have a planned GE appliances app that you can punch in basically everything you have food-wise in your fridge, and it will spit you out as many recipes as possible for what you can make with the food in the fridge. Kind of just showcasing all the tech that's really here now and the possibilities for the future for, I think, the AI space in general, but Google is obviously, designing it specifically for what they're able to do. So Google closed yesterday's session at year-to-date highs, up 50% on the year, while the latest sell-off brought Microsoft down to plus 35% year-to-date. So Google finally starting to catch an edge here. I feel like we've been talking about this name for forever. seeing as it was only up about half what Microsoft was at one point year to date. Google finally starting to win the race and breaking out. We'll see if that can get another bid continuing today.
Yeah, for sure. It's good to see some further participation. I know that, particularly in the June rally, the July rally, we were like, why is Google really like not participating to the same extent that some of these other companies are? And so it's definitely good to see them sort of lift up out of that funk. That'll wrap it up for us here at Fed Forecast. We will pass it back to Alejandro.
All right, thank you, gentlemen. Mander, before we transition here, Google, we've obviously been talking about it for a long time. Something that I had noticed with Google, when everything else seemed to be selling off, Google was very steady, showing a lot of relative strength. While it wasn't really moving, it was just kind of trading flat. So that's exactly what we want to see, and hopefully it does have a good, strong end to the year. It's fun to see it finally starting to go here.
Yeah, the proof was in the pudding. When we saw that whole QQQ sell, it didn't really move, just traded sideways for a couple weeks there.
Exactly. All right. Going to take a look at the S&P futures here quickly, guys. So this week's rally, let's take a look at it from a technical perspective. So this head and shoulders, very notable that we got that developed last week. We saw a lot of people talking about this pattern, and on Monday's show, I highlighted this as well. And the lesson here, and something that's really important to understand with technical analysis and charting patterns in general, is that just because a pattern doesn't work out does not mean that it's not necessarily tradable. And oftentimes, when a pattern fails, those can be very, very powerful trading signals. In the case of this head and shoulders pattern, when we attempted to break down from the neckline, we got what was a fake breakdown. So we broke below the neckline, but then quickly recovered. And that, of course, is bullish. So a lot of people will see the head and shoulders and they will sit there and anticipate either the selling, they'll short below the neckline. That's, of course, the classical way to trade the pattern. That's the stuff that you'll see in all the textbooks. But from a trader's perspective, and how to kind of put yourself in a better position, is to imagine how people are positioned after a move like this. When a classic pattern like this plays out and you get the breakdown below the neckline and you see what is an obvious trap where we sell off, we quickly recover. So what this would do is stop out longs. This would trap shorts who attempted to short this move. Now you can have the edge of knowing that, okay, there are a lot of traders trapped short after this fake breakdown below the neckline. And this is true with, most technical patterns are all technical patterns, right? So they're not necessarily predictive. A lot of people, when they see a head and shoulders, they think, okay, the head and shoulders is developing, the market is going to sell off. The market doesn't sell off until it's confirmed that we break below the neckline. And so that's how traders get trapped. And it's the same thing with bull flags and bear flags. People will post them. Here's your bull flag forming. It's not a predictive pattern. And it only is predictive once you get the confirmation of the breakout. And failed patterns can be just as effective to trade. All right, so that's what we saw last week in the S&P futures. And of course, this week, we got a really strong rally off of that bottoming signal. All right, guys. So that's going to do it for S&P futures. Now going to go over to Matt. Matt, give us an update. I see you now tweeting again some more bullish things, which is good to see. The viewers know that that's obviously something that I love to see. But explain to us what is going on, what has changed, and what are you seeing currently in the market?
Yeah, absolutely. And you guys touched a lot on the points. Despite the idea that there's a possible credit event looming, I don't think it's going to be like a credit crunch or collapse or even a bubbles forming. What's going to happen, is that we're going to have a credit slowdown at some point. But I think it's going to be slow and mild and take a longer period of time than there being some kind of drastic collapse. Because all the data that's coming out is showing decent data and growth. As some of y'all touched on this morning. Yesterday, we had two really great numbers come through, the JOLTS. I gave a whole 2-hour class on the JOLTS yesterday. It's one of the most telling signs of what's going on in the marketplace, the job marketplace, and it can even help you forecast what the Fed's going to do. Like with the JOLTS coming through, let me pop this on my screen really quick. And with the JOLTS coming through, the way that it, let me open this up. the way that it did, right, as when you have job openings coming down, you have one of two things: either companies are eliminating those jobs that they typically had, like for instance in COVID, right, when all the companies were shut down, companies that were sitting there with jobs ready to fill. It's a job that needs to be filled in the 30-day window that has active recruiting and that the worker can start in those 30 days. So when it shut down during COVID, JOLTS just collapsed because companies that were trying to hire people, they had to turn those jobs off. So JOLTS came down. But the other time JOLTS come down is if people actually do go back to work. And that's what was mentioned this morning. And that's absolutely correct. We've been going back to work since, June of last year. And that's around the time when the market pivoted and started growing. And so when you see these things happening, you can pair them up with another indication that's going to come out tomorrow, which is going to be the continuing jobless claims. This is the number of people that are filing for unemployment insurance on a continual basis. And to qualify for unemployment insurance, you had to have been laid off for, for reasons of the company, not reasons of your performance. And so these are people that have been laid off in waves that are now also going back to work. So this is proof of economic growth. Companies don't have jobs that are available and start hiring people back unless the company accepts the workers' cost of their labor for the efficiency or the production they're going to be able to do for the expense they want to charge for their labor. And the reason why people were not able to go to work as quick as possible is because everyone was still stuck on those inflated salaries post-COVID. So what you're seeing actually now is the tug of war between the companies having jobs available and the workers wanting double their salary. And as you can see, with the workers finally going back to work, the desperation of being unemployed is allowing the competition between workers in the job market to accept a lower salary just to go back to work to keep paying their bills. Either way, people are going back to work, but also accepting less money. It's a double-edged sword, which means in a period of inflation, they're going to have less money to spend, and therefore they're going to have, and things are going to be more expensive to buy. So it's going to be harder to for banks to see that as growth for them to lend out credit. So when I talk about credit slowdown, it's that double-edged sword. We still have inflation. The wage inflation part is coming down, but there's still other things that are leading into it. But either case, this is good for the economy. People don't go back to work in a recession. I mean, that's rule number one. And rule number two is we had the print today, and although it was a little less than the expectation, the GDP quarter over quarter growth is still positive. And so the two telltale signs I show, or I like to look at to show for a healthy or somewhat growing economy, is to see GDP quarter over quarter growth being rate positive means you're growing, and having people go back to work, which means they're doing something with their labor for the cost of which you pay for them to come work. So we're producing something, people are getting paid, and you're going to produce things as long as people are coming out and buying them. You're not hitting like a wall in your logistical chain where you have a surplus, and surplus will bring prices down either case. So as long as you have people working and making stuff, that can also drive prices down the road. So this is always healthy for growth in the economy. Things are looking good, and Wall Street is actually agreeing with that because since October, they've been rallying the market because the economical data is looking good. Now, even though there's looming bad news and about all the things related to interest rates, all the things related to quantitative tightening, all the things related to the yield curves, a lot of that stuff is bad-ish. It doesn't mean that the market's going to collapse. Like my scenario is that the worst case scenario is that the market stays sideways for a couple of years because it's still so extremely bullish, especially with the economy growing slightly the way that it is in this environment. There's no signs of immediate pending doom and gloom. And I know when we look at rocket security, we like to look at positions. These are options positions that are strewn out over the course of, this is going till December of this year. What this is actually showing you is the positional risk distribution of the SPY itself. So when you're looking at this to look at the S&P, and when you see this, when you look at these dark gray, these are where bull zone calls are in the money, and this light gray is bear zone. Whenever the light gray tops are sloping down and the dark gray bottoms are sloping down, bulls are getting stronger and bears are covering their shorts. That's what this pattern means. And so this is still showing that we're in a period of short squeeze. And I know a week ago, as the market was bottoming and the bears were doom and gloom, we saw it as a temporary short-term sell-off that's going to turn around and continue to rally. And this slope down on this dark gray right here is implying that same very thing. There are calls that are in the money. It's creating forced hand buying, and shorts are squeezing. So we're reverting to mean and maybe filling the gap. So the market is still reacting very well to good news. It's not just slowly moving on good news and tanking on bad news. The market's actually slowly trading down on bad news and reacting violently to the upside on good news, as shorts are still upside down and in that squeezing position. So the way that we're seeing the market today is a reflection of people still being afraid to be bearish in the market. Another thing to take a look at is the commitment of traders, and this is one of the details we like to bring. Let's see if I have it right here. Commitment of traders is something that shows the distribution of risk in the futures market. And you can see that we do have down here at the bottom, these are the categories we look at: asset managers and leveraged funds. And the blue and the green are two of the most major components of speculative buying. So the green is basically your buy side of the market. The blue is your short side of the market. And whenever these two lines pinch towards each other, there's markets liquid. So when they fan apart, the market's illiquid. And you can see that for the longest time, like I guess since December of last year, this blue line is just, although it's got waves in it, it's just been kind of sloping down as the shorts have become more short. And this green line has been sloping up as long as they become more long. The market is actually liquid as both sides are betting against each other, which is preventing crashes from happening. There's a rule of thumb I always like to say is that liquid markets don't crash. As long as there's a willing buyer, markets don't collapse on themselves. And so that's one of the really neat safety nets you can have. Now in the shorter term, you can see in the last month or so, shorts have been covering and getting out of the way, but also shorting harder, while there's been a little bit of asset managers selling. That explains the sell-off. But right now, things are just looking flat and stable without there being a general trend of the market pulling back. As an example, when we had the sell-off a year ago, green was selling and blue was selling. When they're both pointing down, you get illiquid, volatile markets. When they're both pointing out from each other, you get tighter, shorter Vs, easier to trade, less volatile markets. And the last thing to take note of, and I'll just pull on my screen really quick, is if you look on I think your swim up, is that VIX is again, we open in contango and VIX has been trading down below a key indicator that we look at to see if the VIX is going to have kind of like a good month or a bad month. And if you look at the forward curve, which is all the futures going forward into the VIX, the forward curve is basically flat for the rest of the year, which means people are expecting volatility to remain the same for the rest of the year. Mixing this all together, it's starting to show that the bull case is wanting to start climbing its way back. Now, it's not going to likely be that big sharp rally we've been seeing, but you can see that there is really no bet on volatility or bearishness for the rest of the year, and it's probably because of this good economic data we've been seeing. I think Wall Street is smart enough to see the same things we're seeing, and they've been betting on it all year. So I don't really feel the fearfulness in the market, and I do feel like the problems that most of the bears are saying will come true slowly and over time. And that I still think that we're more likely to double top before we're likely to hit below 400, the S&P. That's still my call. I'm not as aggressive as I was earlier in the year when I said, like we could go to 500 by the middle of the year. It could take another year to get there, but I still think we're going higher before we're going lower, and that the problems are going to have to really manifest themselves. And that credit crunch needs to happen, where credit just dries up, and you're going to start to see all the effects of that on the economical data. And until you see that, I don't think Wall Street's going to bet on that. They're more likely going to keep squeezing shorts to punish them for shorting way too early. That's fine.
All right, Matt. Awesome analysis there, man. Really appreciate that. Great stuff. We're going to quickly transition over now to Bet the Bell. We're going to do a speed round to wrap up today's show.
So I'm going to start it off with the first question of the day that we always go with: green or red? We could see that Diamond is currently winning in the standings. I'm going to start this one off with Alejandro. Chance to get your redemption.
Green today.
Diamond, what you got?
I'm going to go green as well.
Matt, what you got?
Green, and that leaderboard is tight. You guys are tied at first and second, man. It's neck and neck.
It's been like that for months,
Wow.
I swear.
Money Mander.
Also taking green.
I'm going to make it green across the board. 5 greens. Like it. So I'm going to transition over towards my next question, which I find this one pretty interesting. Will Celsius break $200 by the end of the year? When I'm talking end of the year, I'm talking calendar year. And we just saw a new all-time high by Celsius yesterday. We're sitting currently at 185, I believe. Hondo, what do you think?
Yeah, I think it will. I was just taking a quick look at the chart. Obviously, a lot of strength. I'm not going to lie here, guys. I didn't even know that Celsius was publicly traded until yesterday. So this stock is a ripper. I wish I would have invested, obviously. It's trading under $10 in 2020. Pretty crazy, but I like Celsius, the drink, so why not?
188.87 is the high. Mander, what do you got?
Yeah, I was in Hondo's boat. I actually didn't know this was a public company until the start of August when I saw their blowout earnings that really sent this thing to the moon. If you see the huge gap up from 140 to like I think it opened at 170. Huge blowout on earnings. I think this definitely takes out 200 by end of year. I think this does it relatively quickly. If you take a look at the chart, just from a technical standpoint, it got this breakout of this ascending triangle here. Closed at highs yesterday, breaking out above that 183 zone. So I think this could see 200 pretty quickly.
Diamond, what you got?
Yeah, I agree. I mean, we're pretty close there already. It's less than 10% away. Yeah, I think that we could see that. I mean, Celsius, again, like Alejandro said, Celsius is one of those things where like you get told when you're young, like just invest in companies that you use and things like that. And even though I don't use Celsius, my brother drinks them religiously. I know so many people who use the product. It's definitely something that I would have loved to take a flyer on back in the day. But yeah, I could definitely see it popping above 200.
Matt, what do you got?
I mean, Celsius, it's terrible. Like, who drinks that stuff? I mean, it's horrible.
It's hilarious.
The worst. Oh my gosh. I order it from Amazon like every 3 weeks. I get a case. Stuff is great. I mean, it's my favorite energy drink. I actually, I think that it's going to break those 200 level by the end of the year. I think it will. I mean, it's marketing's great. The drink is great. I mean, I honestly believe in the company, and I think that they're slated for good things. As other energy drink companies have been around for a while, it's hard to break into that market, and they've done such a great job with it. And the fact that they're dominating as quickly as they are, got good hopes for the management of that company.
They'll break 200 off of Matt sales alone.
Yeah.
I'm going to bring up my next and final question for the day, but we could see that in China right now, they have cut tax on stock trading. This is the first time since their 2008 global home crisis when we've seen them do this. What do you think that the U.S. reaction would be if we cut taxes? And do you think that the U.S. should cut taxes on trading? I'm going to go ahead and start this one off with Alejandro.
Yeah, I do think that the U.S. should cut tax on trading. What do you think, brother? I mean, no shit. Short-term traders obviously get smoked with taxes. Futures traders a little bit better, which is really nice. So, I do get an advantage there. But yeah, of course, it's fucking hard enough, man. It's hard enough. Cut us some slack.
Matt, what do you think?
I mean, who would love to trade tax free? I mean, that's something everybody would want. So the question is, should we cut tax on trading? Now, again, I don't want to. It's hard to say. I mean, personally, obviously, I'd like to increase my gains as much as possible, but I know capital gains tax is such a huge, revenue stream. So, should we? What are the greater implications of cutting tax? It's hard to wrap your head around that and the amount of money that shifts around on Wall Street. So, if I just isolate this to like my personal desire, yeah, they should cut taxes on trading. But as far as the global economy is concerned, or the U.S. economy is concerned, they probably shouldn't. It's a big revenue stream.
What reaction do you think the market will see if this happens?
I don't think it's gonna be anything. And people have to go, even if everybody heard that news and went open a brokerage account, they still got 1 to 2 days before they can even go, oh, I'm gonna be a trader now because you don't have to pay taxes. I don't think it's gonna affect anybody's performance, gains, frequency of trading. I think if there's a knee-jerk reaction, it'd probably undo itself within a day.
Mander, what do you think?
I'm going to have a similar answer in that would I personally love for them to cut taxes on trading? Yes, but should they? No, I don't think so. I think capital gains right now is probably priced fairly. For most people, it's less than half your income tax. So capital gains, if you hold positions for over a year, and futures, for Alejandro's point, gets taxed like capital gains, it's just about under half, depending on your income tax bracket, obviously. I think that's pretty fair. And obviously, the way we're front-running GDP with our debt ceiling, I do not really want to see anything get cut out of this. So I think for the greater good, we should not take a cut on taxes for trading.
I like your answer.
Mm-hmm.
Diamond, what you got?
Yeah, I'm in Mander's boat here, where I don't think that the U.S. should do that. It's weird because like traders don't really produce anything, right? I think trading doesn't necessarily produce any benefit for anybody outside of the trader himself. Long-term investing, however, does have like a benefit, and for the United States government, you want to incentivize people to invest for the long term, because the more well capitalized that people are come retirement, the less money that the government has to put up to fund your retirement. And so you want to incentivize people to invest for the long term, and that's exactly what the tax code does right now. And so I think that it's fine. I don't think that it should be changed. I think that we should continue to incentivize individuals to invest for the long term, because at the end of the day, if they don't, we're the ones who wind up footing the bill. And so, yeah, I don't think that it would be wise to get rid of it completely, or even reduce it.
I will say the only counterpoint I'll make, or not a counterpoint, but something you said, is that traders. Because now you got me feeling guilty here, like I'm useless to society. But bigger money hedge funds that do short-term trading, that trade investors' money, they're helping people out. So
I mean,
they're helping the rich out.
I understand what you're saying. At the same time, like, what are they producing? Like, what do you make?
What was it? We make money. What movie was that from? What do you make? We make wealth. We create wealth.
Yeah, it's like
wealth creation. What's more powerful than that?
Yeah. Well, I mean, half of them. How many hedge funds underperform the S&P 500? So, like, what are you really creating? Like, you're creating the sense of security for billionaires who have too much money to that they know what to do with, so they give it to some hedge fund manager. Like, that's, you're creating a sense of security for those people that when the market drops 20-30%, that your hedge fund is going to beat the market. Like, that's literally what your job is.
When we start a hedge fund and we have the benefit of this beautiful tax cut. To make Noah feel better, we'll buy a farm and we'll produce crops, and then we'll be contributing to society.
All right, that'll wrap it up for Bet the Bell today. I'm going to go ahead and pass it
Food
back.
is always in demand. I mean, that's what people have to eat, right?
Exactly.
There you go.
All right, guys, that's going to do it for this morning show. Went a little bit past the hour here, but good stuff. Appreciate everybody who tuned in. Thanks a lot, guys. Thanks a lot for interacting. We'll be trading live all day in the King Capital Discord. You guys can go to king-capital.com or scan the QR. Oh, that's the Rocket Scooter QR on the code. First off, Matt, obviously appreciate him joining us. If you guys want to check out Rocket Scooter, I personally vouch for Rocket Scooter all the time. I use it every single day in my trading. It's a phenomenal platform. Everybody up here uses it. So
we have an announcement too, if you don't mind me.
Sure, yeah.
We just launched live futures trading with a brokerage edge clear, so you can actually sign up for brokerage accounts and trade through the platform now. And live futures data now comes into the platform. It's a huge release. We're excited to share that with you guys as our next milestone in the platform.
Awesome, man. Congratulations. I know you guys have been waiting to get that going for quite a while now. So really awesome to see it up and running. All right, guys, that's going to do it for this morning's show. Once again, appreciate everybody who tuned in. We'll be back live on Friday morning, 8:30 a.m. Eastern time. Have a great rest of your day, everybody. Good luck trading.